Welcome to the deep dive. So, if you're a high-earning professional, a W-2 earner, you probably know the feeling.
That frustration, right?
Yeah, like you're playing the wealth game with one hand tied behind your back. You make good money, sure, but that active income, it gets taxed so heavily.
And the deductions are just so limited.
Exactly. Meanwhile, you see people in real estate getting these huge write-offs, and you think, how do I get in on that without, quitting my day job?
Mm-hmm. And that feeling of being stuck, that's exactly what we need to talk about today. There's this common myth, right, that you absolutely have to be a full-time, licensed real estate pro to get significant tax savings from property.
But that's not the whole story, is it?
Not at all. Our sources point to a really powerful, uh, totally legal strategy. It's often overlooked, actually. It lets everyday professionals use real estate investment, specifically short-term rentals, think Airbnb, to offset that highly taxed job income.
Okay, so that's our mission for this deep dive. We're going to show you exactly how this works, like
Right.
down to the specific IRS rules you need to hit.
All right, so you can potentially build wealth faster and, importantly, legally keep more of the money you already earned.
And we've got sources that really lay out the key differences, between active and passive income. And crucially, they explain the classification that unlocks this whole thing.
Yeah, it's fascinating, really. The whole solution turns on understanding why the IRS treats different income streams the way they do. So let's start with those basics, because honestly, the definitions, they're everything here.
Okay, let's do it. So W-2 income, your salary, your bonus, that's the classic example of active income.
Right, you work, you get paid, heavily taxed, very few ways to reduce that tax bill directly.
Then on the other side, you've got passive income. And traditional real estate like long-term rentals usually falls there.
Typically, yes. If you rent a place out for, say, a year at a time, any income, or importantly, any loss from that property is usually considered passive by default.
And that's the big roadblock for most W-2 folks trying to invest in real estate. Let's say your long-term rental shows a loss on paper, maybe because of depreciation or expenses.
Which happens quite often, especially early on.
Right. But that loss, it gets trapped. It can generally only be used to offset other passive income, maybe from another rental or some other passive investment.
It can't touch your main job income. Your W-2 salary is safe from those losses, which sounds good, but it also means the losses don't help reduce your biggest tax burden.
We call that the passive loss silo, basically. The losses are stuck in there.
Exactly. The rules essentially lock them away. So that standard real estate loss strategy, it just doesn't work for professionals trying to cut down their high W-2 taxes. They feel stuck because those passive losses can't jump out of the silo.
Okay, so if long-term rentals trap the losses, how do we get them out? That brings us, I guess, to the short-term rental exception, Section 2.
This is where it gets interesting.
Yeah.
The IRS actually treats short-term rentals differently, fundamentally differently than long-term ones.
Why is that?
Well, they recognize that managing something like an Airbnb or, a vacation rental, it's much more involved than just collecting a rent check once a month.
Right, more hands-on. So what's the specific rule? The threshold the sources mention.
The key is the average length of stay. The sources are crystal clear on this. If the average stay for your renters is 7 days or less,
7 days, okay.
then that property falls into a distinct category. It's not arbitrary. The IRS gets that managing stays under 7 days means intense, high turnover work.
Like coordinating cleaners almost daily, handling constant bookings, immediate guest issues.
Exactly. It operates much more like a hotel, like a hospitality business, rather than just a passive long-term hold investment.
That makes sense. So the IRS views it as needing active input, not just passively holding an asset. And if your rental meets that 7-day average stay,
Then you get the opportunity to classify the activity not as a passive investment, but as an active trade or business.
and that is the power shift we were talking about.
That's the key. Once it's classified as active, you can potentially bypass that passive loss silo we mentioned.
So those losses, the paper losses, can now potentially offset your W-2 income.
Correct. And crucially, you can achieve this without needing that official real estate professional status from the IRS, which has its own very high bars to clear.
Okay, that's the hook. But I sense there's a catch. There's always a catch, right? You have to jump through some hoops to make that reclassification stick.
There is a major hoop, yes.
Yep.
You have to prove something called material participation. That's the gatekeeper term. Let's call this Section 3.
Material participation. Okay, what does that mean in practice?
It's basically how you prove to the IRS that you are genuinely running an active business. You're not just writing checks or having someone else do everything. It's the bridge that connects those potential rental losses to your active W-2 income.
So I can't just buy an Airbnb, hire a property manager to handle everything, and then claim the losses against my salary?
Generally, no. That usually wouldn't meet the material participation tests. The sources lay out, I think, 7 ways to potentially qualify. But for W-2 earners, 2 are the most common and relevant.
Okay, what are they?
First, you need to spend at least 100 hours per year personally managing the property.
100 hours. Okay, that's maybe 2 hours a week. Manageable, perhaps?
It seems manageable for many. But the second rule, this is often the bigger hurdle.
Uh-oh. What is it?
You must spend more time managing that property than any other single individual.
Wait, more time than anyone else, including a professional property manager I might hire. Or cleaners.
Right.
Or co-hosts.
Exactly. So if you hire a manager and they log, say, 120 hours working on your property, you need to log at least 121 hours of your own time.
Hold on, let me push back on that a bit. We're talking about high-earning professionals here. Doctors, lawyers, tech executives. Their time is incredibly valuable, hundreds of dollars an hour sometimes.
Absolutely.
Are we really saying they need to spend 120, maybe 150 hours a year personally handling bookings, maybe even coordinating cleaning schedules just for a tax break?
Yeah.
It sounds like trading a high-paying job for a much lower-paying one in terms of time.
That is precisely the trade-off. And you're right to question it. That high-value W-2 earner has to do the math. Do the tax savings, which can be tens of thousands of dollars, outweigh the opportunity cost of their time?
So what kind of activities count towards those hours? Does it have to be scrubbing toilets?
Thankfully, no. Not necessarily scrubbing toilets yourself. It includes things like managing the online listings, handling guest communication directly, coordinating maintenance even if you outsource the actual work, ordering supplies, paying bills, and, critically, documenting all this time meticulously.
Okay, so it's active coordination and decision-making, not just passive ownership.
Correct. Your personal involvement and the proof of that involvement is what convinces the IRS it's an active business for you. You absolutely cannot just outsource the core management functions entirely and expect to qualify under these main tests.
Got it. So that documented time is really the price of entry for this strategy. You need rock-solid proof you met those thresholds.
Absolutely. Without it, the whole strategy can fall apart under scrutiny.
Okay, which leads us nicely into the payoff part. Section 4. How this actually saves you money. The benefit comes from leveraging expenses, particularly non-cash ones like depreciation, to create a big paper loss.
Right. This is where we use established accounting principles, totally legally. Depreciation is a fantastic tool here. The IRS lets you deduct a portion of your property's cost each year, assuming it's wearing out or losing value.
Even if, in reality, the property value might be going up.
Exactly. And the beauty is, depreciation isn't cash leaving your pocket that year. It's an expense on paper that shields your actual income, but doesn't necessarily hurt your cash flow from the rental itself.
So how do people maximize this? How do they create a large enough paper loss in year one to really make a dent in their W-2 income?
That often involves a more advanced tactic called a cost segregation study.
Cost segregation. Okay, what's that?
So instead of just depreciating the entire building slowly over, say, 27.5 years for residential property, a cost segregation study identifies specific components within the property. Things like appliances, carpeting, landscaping, maybe even some electrical or plumbing fixtures.
And those things can be depreciated faster.
Much faster. They can often be depreciated over 5, 7, or 15 years instead of 27.5. This front-loads a huge amount of depreciation expense into the early years of ownership, especially year one.
Got it. So you take a bigger write-off sooner.
Precisely. That's the engine that drives the really significant paper loss in the first year or so.
Yeah.
Let's walk through that example from the sources.
Okay. Let's say we have our W-2 earner making $150,000 a year. They've bought a short-term rental property for, say, $600,000. And crucially, they have meticulously documented their 100-plus hours and proven they spent more time than anyone else they met material participation.
Right. Now, you add up all the legitimate cash expenses, mortgage interest, property taxes, insurance, utilities, cleaning fees, supplies. And then you add that big accelerated depreciation number you got from the cost segregation study. Let's say, after all that, the property shows a paper loss for tax purposes of $50,000 in that first year.
A $50,000 loss on paper. Now, the magic part. Because they qualified the STR as an active business through material participation?
That entire $50,000 paper loss can flow through and directly offset $50,000 of their $150,000 W-2 income.
Wow. So their total taxable income just dropped from 150K down to 100K.
Instantly. And depending on their tax bracket, that translates to thousands, potentially tens of thousands of dollars in actual tax saved. Money they legally get to keep.
And let's just hammer this home. The investor didn't actually lose $50,000 in cash.
Right.
The property might have even made money cash flow-wise.
That's entirely possible, even likely in a well-run STR. They simply use an IRS-approved accounting method depreciation, accelerated via cost segregation to create a non-cash expense that shields their other high-taxed income.
It really is turning a tax liability into a powerful investment advantage.
That's why it's so transformative for W-2 earners trying to get ahead and build wealth more effectively.
Okay, which brings us to the practical side, Section 5. We need to address some common myths, but also really stress the seriousness of the requirements.
Yeah, absolutely. First myth, you have to quit your job. Not true. This strategy is designed for people with W-2 jobs.
Oh, okay. Myth 2, you need a whole bunch of properties.
Also not true. Especially with cost segregation boosting the year one depreciation, even a single, well-structured short-term rental can generate substantial tax savings.
And it's a big but. The requirements are strict. This is a powerful strategy, and let's be honest, powerful strategies can sometimes attract IRS attention. What's the #1 reason people get into trouble with this if audited?
Documentation, or rather, lack thereof. It almost always comes down to documentation. Remember those material participation rules, the 100 hours, the more time than anyone else rule? You must have proof. Diligent, contemporaneous logging of your time isn't just a good idea, it's essential. You need a detailed log showing dates, times, specific activities performed, not just some estimate scribbled down at the end of the year.
So we're talking about maybe using tracking apps, keeping detailed notes of guest messages, calendar entries for coordinating cleaners, saving receipts for supplies, building a real paper trail throughout the year.
Yes, exactly. You need to be methodical. The IRS knows high earners value their time. If you claim you spent 150 hours personally managing an Airbnb while also working a demanding job, you need detailed, credible records to back that up. They need to withstand scrutiny.
And the final crucial piece of advice.
Work with the right professional. You absolutely need a certified public accountant, a CPA, who truly understands real estate taxation.
Not just any CPA.
No. Ideally, someone with specific experience in short-term rental rules and, very importantly, cost segregation studies. A generalist might not know the nuances, might be hesitant to apply the strategy correctly, or might not structure it optimally to defend against an audit.
So finding a knowledgeable CPA is key to doing this right and minimizing risk.
It's essential. Consider that CPA part of your investment team for this strategy.
Okay, let's pull us all together then. The core message here is W-2 earners, you high-income professionals, you can potentially break out of that passive loss limitation cycle.
Right. The path involves short-term rentals average stay under 7 days and classifying them as active businesses.
Which requires proving material participation. Typically, that means logging at least 100 hours a year and, crucially, spending more time on it than any other individual involved.
And if you do that, you can potentially use the paper losses, often supercharged in year one by cost segregation,
to directly reduce your taxable W-2 income, saving potentially thousands in taxes.
while also building equity in a real estate asset. It's about legally keeping more of what you earn and putting it to work building long-term wealth.
It's a powerful combination. Okay, fantastic deep dive. Before we wrap, though, let's leave our listeners with something to think about, drawing from everything we've discussed.
Okay, so given those strict requirements for material participation, the 100 hours, yes, but especially that rule about spending more time than anyone else, how might that necessity influence your actual investment decisions? Think about it. Does the pressure to log those hours, to be the most involved person, maybe change how you'd otherwise run the property? Perhaps you make choices based on maximizing your documented time rather than purely maximizing cash flow or guest experience in the most efficient way.
Interesting. Are you optimizing for the tax break itself, potentially at the cost of pure investment efficiency?
That's the question to ponder. That active commitment and the need to prove it is really the hidden cost of accessing this significant tax advantage, something to weigh as you consider if this strategy fits your goals and your tolerance for active involvement.
Definitely food for thought. Thanks for digging deep with us today. We'll catch you on the next one.